Banks do not fail loudly anymore. They hesitate. Transfers clear, but slower than yesterday. Credit approvals come with extra steps. Authorization wheels spin longer on screens that used to respond instantly. Nothing breaks, nothing crashes, yet friction creeps into places designed to feel invisible. That friction has a name: extend and pretend. A clause that allows banks to avoid marking assets to reality, creating phantom stability while real losses sit untouched. Balance sheets look fine, markets stay calm, but the system begins to drag, like a machine running without oil. Sound familiar? This is the glitch in the matrix, not chaos, delay. Assets are valued at prices nobody would pay. Loans are rolled forward instead of written down. Losses are deferred, not erased. On paper, capital survives. In practice, risk accumulates. The public sees stability, the plumbing feels strained. Every extra second at checkout, every delayed settlement, every quiet limit increase denied. These are not coincidences, they are symptoms. This isn't a theory or a conspiracy, it's a mathematical certainty. The United States is carrying over $38 trillion in federal debt, while the banking system sits on roughly $1.5 trillion in commercial real estate exposure, scheduled to reset by 2026. Rates changed. Values didn't recover. Cash flows weakened. That gap cannot be wished away. It can only be postponed. Let that sink in. To understand why the crash hasn't arrived, you need the framework every systemic failure follows. 4 acts, always the same. The foundation, the trap, the trigger, the cascade. People argue endlessly about the trigger. They miss the point. By the time the trigger appears, the outcome is already baked in. And here is the uncomfortable truth. We have already completed the first 2 acts. We are walking through the door of the third. The foundation is built during calm, cheap money, easy credit, confidence mistaken for safety. Banks extend duration. Borrowers assume refinancing will always exist. Commercial real estate is priced as if occupancy never falls. Government debt grows because funding feels painless. Everyone believes the future will resemble the past. It always does at this stage. The foundation hardens. Then comes the trap. Rates rise, not slowly, quickly. Asset values fall, not on paper, but in reality. Here's the problem. If banks sell, losses become real. If they mark to market, capital vanishes. If they raise equity, markets panic. So they do none of those things. They extend loans. They modify terms. They reclassify risk. They pretend the asset will recover with time. This is not fraud. It is policy. Approved, codified, encouraged. Sound familiar? Extend and pretend freezes the system in place. It stops immediate collapse, but at a cost. Capital becomes fictional. Liquidity becomes selective. Credit exists, but only for those who already have it. The economy keeps moving, but unevenly. Strong borrowers survive. Weak ones fade. The banking system remains upright but fragile. It is not healing. It is pausing. This is where we stand now. Stage 3. The trigger phase. Not the explosion, the recognition. The moment when postponement stops working. Triggers are never dramatic at first. They are administrative. A regulation expires. A facility closes. A loan finally defaults without extension. A court forces recognition. One bank marks reality. Others follow. The trigger is boring until it isn't. Why 2026? Because time runs out. Commercial real estate loans written at peak valuations mature. Refinancing assumes rates that no longer exist. Cash flows do not cover debt service. Extend and pretend can roll some loans. It cannot roll them all. Eventually, someone must admit the loss. That admission spreads, quietly, relentlessly. The public expects collapse to look violent. It rarely does. More often, it looks like control. Restrictions, adjustments, limits. Transactions still happen, but slower. Credit still exists, but narrower. Stability remains, but only on the surface. Beneath it, pressure builds. Banks conserve. Regulators watch. Markets pretend nothing is wrong because pretending is safer than knowing. History doesn't repeat, but it rhymes. Every system that delayed recognition believed time would save it. Spain thought silver would mask decay. Britain thought empire would sustain sterling. Banks think rolling loans will restore values. Time does not heal balance sheets. It exposes them. Extend and pretend works only while belief holds. As long as depositors stay calm. As long as markets trust the marks. As long as nobody forces the truth into daylight. The moment belief cracks, the clause loses power. Stability turns into suspicion. Liquidity evaporates where it was assumed permanent. People sense this shift before they can explain it. Banks add questionnaires. App updates introduce new disclosures. Customer service scripts grow longer. Language becomes careful. Temporary becomes extended. Extended becomes normal. Normal becomes permanent. Each change is small enough to ignore. Together, they redefine stability. This is how systems train populations to accept less access as protection, less speed as safety, less choice as prudence. Nobody announces the change. It arrives through policy footnotes and compliance emails. By the time the pattern is visible, it feels inevitable. And inevitability is the most powerful anesthetic of all. Here's the cliff edge. The system does not fail when people panic. It fails when people realize panic is unnecessary because the outcome is already managed. When controls replace confidence. When delays replace access. When the matrix stutters often enough to be noticed. Watch the friction, count the delays, measure the hesitation. These are not bugs. They are features of a system buying time. Time is the only asset left. Once recognition begins, speed replaces silence. Correlation replaces isolation. And the calm everyone trusted reveals itself as carefully maintained illusion. The pause is ending. Arithmetic does not negotiate. It collects. The bill always arrives, and nobody rings the bell. You feel it anyway. Once recognition begins, the story stops being theoretical. This is where history matters. Not as trivia, but as proof. Because systems like this have reached this point before. Different centuries, different currencies, same logic, same ending. History doesn't repeat, but it rhymes. Look at Spain in the 16th century. Silver flooded in from the New World, ship after ship, treasure beyond imagination. On paper, Spain was solvent forever. In reality, the silver masked decay. Domestic industry collapsed because imports were cheaper. Debt ballooned because money felt endless. Losses were hidden behind inflows. When silver slowed, the illusion shattered. Spain didn't collapse in a single year. It stagnated. Controls followed. Defaults came later. Extend and pretend existed then too. It just had a different name. Fast forward to Britain. After World War II, the empire still stood. The navy still ruled the seas. The pound still circulated globally. But the balance sheet was broken. Britain chose delay over default, capital controls, rationing, managed decline. The pound was defended on paper long after it lost real dominance. The crash never came. The erosion did. Sound familiar? Now look at the present system. The tools are more sophisticated. The language is softer. The goal is the same. Delay recognition, spread losses, maintain confidence. Official data confirms it. Start with U.S. Treasury numbers. Interest expenses rising faster than economic growth, faster than wages, faster than tax receipts. Debt service is compounding into a structural burden. That alone would be manageable if banks were healthy. They are not in the way balance sheets suggest. Look at SEC filings. Large banks quietly disclose unrealized losses in footnotes. Not headlines. Pension funds shorten duration. Insurance companies reduce exposure. Risk is being repositioned, not eliminated. This is not panic. It is preparation. Smart money never waits for confirmation. It moves when patterns align. Then look at central bank behavior. Gold purchases at record levels, year after year. This is not speculation. Central banks hedge system risk. When they increase gold while maintaining public confidence in fiat, they are signaling privately what they deny publicly. They expect volatility. They expect adjustment. They expect recognition. Extend and pretend delays that recognition, but it does not remove it. Commercial real estate is the pressure point. Office buildings priced for occupancy that no longer exists. Loans written with assumptions that died when rates rose. Maturities converge around 2026. Refinancing requires valuations that markets refuse to support. Banks roll loans instead. They restructure. They capitalize interest. They pretend the asset will recover if given time. Time is running out. Here is where belief becomes dangerous. People assume the absence of collapse means health. They confuse delay with recovery. They trust smooth surfaces. They ignore friction. But friction is the signal. It tells you energy is being lost inside the system, quietly, constantly. Extend and pretend creates a frozen middle. Assets are neither sold nor resolved. Capital is neither destroyed nor restored. The system becomes rigid. Rigid systems break suddenly when flexibility disappears. That is the risk policymakers are managing, not preventing. Managing. This is why the phrase, "this time is different," always appears here. Technology will save us. Artificial intelligence will boost productivity. Growth will outrun debt. Military power will defend the currency. History laughs at these arguments. Rome had technology. Spain had silver. Britain had empire. None of them escaped arithmetic. Innovation changes speed, not destination. Military power does not protect purchasing power. It never has. Currencies die quietly while armies remain strong. Control replaces confidence. Access replaces abundance. The public is told stability has been preserved. They feel something else. Sound familiar? Extend and pretend works best when people are distracted, when markets are calm, when daily life continues. But the longer it runs, the more distorted the system becomes. Healthy assets are trapped alongside toxic ones. Capital cannot flow where it is needed. Credit allocation becomes political. The economy loses resilience. This is the phase where policymakers hope for a miracle, a rate cut cycle that arrives early enough, inflation that erodes losses without spiking costs, growth that justifies old valuations. Sometimes miracles happen. Often they don't. When they don't, the cascade begins. The cascade is not a crash at first. It is correlation. One institution recognizes losses. Another follows. Liquidity tightens. Lending slows. Markets reprice together. What was isolated becomes systemic. Extend and pretend stops working because there is nothing left to extend. The door closes. Here's the most important point. The cascade does not start when people panic. It starts when authorities admit delay has reached its limit, when rules change, when facilities expire, when recognition becomes unavoidable. That moment will not be announced as a crisis. It will be announced as a technical adjustment, a prudent measure, a safeguard. The public will be told stability remains intact. They will notice access shrinking, credit narrowing, friction increasing. They will feel poorer without understanding why. This is how late-stage systems resolve. Quietly, administratively, inevitably. 2026 is not a date on a calendar. It is a convergence, deferred losses, maturing loans, political cover fading, accounting reality returning. Extend and pretend was never meant to last forever. It was meant to buy time. Time has been spent. And this leads to the final question. Not whether the cascade happens, but who is prepared when it does. Because once recognition spreads, there is no pause button, only positioning, only adaptation, only survival choices made before the door fully closes. That is where this story goes next. The part nobody wants to hear, the part that decides outcomes, the moment when delay ends and consequence begins. This is the moment people resist the most. The moment when evidence is clear, patterns align, and denial shifts into reassurance. This time is different. It is always said here, at the edge, right before consequence replaces delay. Technology will save us. Artificial intelligence will unlock productivity. Financial engineering will smooth the transition. Military strength will protect the currency. Confidence will hold. Sound familiar? History is brutal with these claims. Rome believed its engineering made it permanent. Roads, aqueducts, logistics beyond any rival. It still debased its currency. Spain believed silver guaranteed dominance. It still hollowed itself out. Britain believed empire and naval power would defend sterling. It still lost reserve status and endured decades of decline. Innovation never erased debt. Power never stopped arithmetic. Every empire learned the same lesson late. Stability is not strength. It is timing. Extend and pretend is the modern version of that belief. A sophisticated delay mechanism wrapped in regulation and policy language. It does not exist to save everyone. It exists to manage the sequence of losses, to decide who absorbs them first, to prevent disorder while control is established. This is not malicious. It is mechanical. Once you understand that, the fog lifts. The Federal Reserve and regulators are not choosing between good outcomes and bad ones. They are choosing between bad and worse. Immediate recognition would cause panic. Delayed recognition causes erosion. Modern systems always choose erosion. It is quieter. It is politically survivable. It spreads pain across time instead of concentrating it in a moment. This is why collapse narratives miss the point. The danger is not sudden failure. It is gradual confinement, limits disguised as protection, friction framed as safety, access replaced with permission. You do not lose everything. You lose options. And losing options is how systems reshape behavior without revolt. Let that sink in. This is where survival becomes relevant. Not survival in the cinematic sense, survival in the structural sense, positioning yourself so you're not fully dependent on one outcome, one institution, one policy path. The first survival step is diversification away from single system dependence. This does not mean abandoning dollars or exiting society. It means recognizing concentration risk. When all income, savings, debt, and assets depend on one monetary authority behaving perfectly, you are exposed. Diversification is not about returns at this stage. It is about optionality, the ability to move if conditions change. The second step is liquidity with purpose. Not cash for comfort, cash for flexibility. Liquidity buys time when others are forced to act. It allows you to absorb shocks without selling assets in distress. It gives you leverage when credit tightens. In late cycle environments, liquidity is not laziness. It is defense. The third step is reducing exposure to leverage that cannot adjust. Fixed obligations in a system losing purchasing power are traps. Mortgages, variable rate debt, balloon payments, refinancing assumptions. Leverage magnifies outcomes. When the system expands, leverage rewards. When it constrains, leverage punishes. Reducing it restores breathing room, not overnight, intentionally. The fourth step is institutional redundancy. Banks are not equal. Jurisdictions are not equal. Regulatory regimes diverge under stress. Keeping everything in one place, one bank, one structure, is efficient until it isn't. Redundancy feels unnecessary until it becomes essential. This is not about distrust. It is about resilience. The fifth step is investing in human capital, skills, adaptability, networks. In every historical transition, the people who fared best were not those with the most assets, but those with the most flexibility, skills that transfer, knowledge that compounds, relationships that open doors when systems reorganize. When money tightens, capability becomes currency. The sixth step is psychological preparedness. This matters more than most people admit. Late-stage systems punish denial. They reward realism. Understanding that stability is conditional changes how you plan, spend, and commit. It shifts time horizons. It alters risk tolerance. It removes the shock when constraints appear. Calm is an advantage. None of these steps are about beating the system. They are about not being crushed by it. Because here's the truth few will say plainly. The cascade will not reset everything cleanly. There will be no moment where the slate is wiped and opportunity magically appears. What comes instead is a long adjustment, managed decline in purchasing power, rising administrative controls, narrowing access. The system survives. People adapt. Life continues. But the rules are different. Extend and pretend delays this realization. It does not prevent it. When recognition finally spreads, it will feel anticlimactic. No sirens. No collapse. Just a new normal that feels smaller than the old one. That is how modern cycles end. The people who suffer most are not those who saw it coming. They are those who believed stability was permanent, who assumed access was guaranteed, who ignored friction because nothing had broken yet. Watch the signals, delays, limits, language shifts, policy footnotes. These are not noise. They are the system teaching you what comes next. The extend and pretend clause was never hidden. It was ignored. Because acknowledging it means acknowledging that stability is curated, not organic. That confidence is managed, not earned. That time is being bought, not found. Time is almost spent. When the door fully closes, there will be no announcement, only consequences. Only outcomes determined by positions taken before recognition became unavoidable. History doesn't repeat, but it rhymes, and every rhyme ends with the same lesson. Those who recognize the pattern early adjust quietly. Those who don't call it a surprise. The matrix does not shatter, it tightens. By the time you feel the pressure clearly, the choices have already been made.